If you've spent even a few days learning about trading, you've probably heard this advice before. Never risk more than 1% on a single trade. And honestly, it's one of the most important risk management rules in trading. But here's something nobody tells beginners. Most traders don't break this rule because they don't understand it. They break it because trading becomes emotional. And after years of watching beginner traders, and honestly making some of these mistakes myself early on, I've realized something. Trading psychology destroys more accounts than bad strategies ever do. Today, I want to talk about why the famous 1% rule falls apart for so many traders, how revenge trading slowly takes over, and what experienced traders do differently to stay consistent. This video is not financial advice. It's purely educational and based on common trading psychology mistakes that many traders experience. Imagine this. You spend hours analyzing a setup. You check the trend. You mark support and resistance. You wait patiently for confirmation. Everything looks perfect. Finally, you take the trade. Then the market moves slightly against you. Your stop loss gets hit, and you lose the trade. Frustrating, but completely normal in trading. Then something painful happens. A few minutes later, the market goes exactly where you originally predicted. The trade would have worked perfectly if your stop loss was just a little wider. And suddenly, you're not thinking logically anymore. You're angry, not because your analysis was wrong, but because you feel like you were almost right. And this exact situation traps thousands of beginner traders every single day. At first, you try to stay disciplined. You tell yourself, it's fine, I'll just wait for the next setup. But emotionally, you already want your money back. So you open another trade. This time, maybe you risk a little more. Not because your setup is better, but because your emotions are stronger. And this is where trading becomes dangerous, because now you're no longer following your system. You're reacting emotionally. This is called revenge trading. And according to many experienced traders, this is one of the fastest ways beginners blow up trading accounts. Because once emotions take control, discipline disappears. Now every trade feels personal. You stop asking, is this a high-quality setup? And start asking, how fast can I recover my loss? That mindset alone can completely destroy consistency. Most beginners think their biggest problem is strategy. They believe, if I just find the perfect indicator, the perfect entry, the perfect system, then trading will finally become easy. But experienced traders know something important. The market is not the hardest part. Controlling yourself is fear, greed, impatience, overconfidence. These emotions quietly affect trading decisions every single day. And the scary part? Most traders don't even notice it happening in real time. They think they're being confident when they're actually becoming emotional. This is why professional traders spend so much time focusing on risk management and psychology. Because long-term trading success is usually more about consistency than excitement. One thing many experienced traders agree on is this. Watching charts nonstop can increase emotional decision-making. Think about what happens during live trading. You watch candles moving every second. Your profit goes green, then red, then green again. Your emotions react to every tiny movement. Fear becomes stronger. Greed becomes stronger. Stress becomes stronger. And eventually, you stop following your original plan. This is why some traders prefer higher time frames like the 4-hour or daily chart. Less noise, less emotional pressure, better decision-making. Sometimes doing less actually improves trading performance. So what do disciplined traders usually focus on? First, many experienced traders actually risk less than 1% per trade. Some risk only 0.5%, some even lower, because smaller risk keeps emotions manageable. And emotional control is critical in trading. Second, good traders accept losses as part of the process. This is something beginners struggle with. A losing trade does not automatically mean you're a bad trader. Even profitable trading systems have losing streaks. That's completely normal. Professional traders lose trades all the time. The difference is, they don't emotionally react to every loss. Third, experienced traders often rely on mechanical rules, meaning fixed risk, fixed entries, fixed stop losses, fixed trade plans. The fewer emotional decisions involved, the more consistent trading usually becomes. And finally, backtesting. Backtesting is one of the best learning tools for beginners. When you practice on historical charts and review hundreds of trades, you begin understanding probabilities. You realize losses are part of trading. And once you truly accept that, you stop panicking after every bad trade. Here's the truth: most beginners eventually learn the hard way. Trading is not just a technical skill, it's emotional discipline. The market constantly tests your patience, your confidence, and your ability to stay calm under pressure. And most traders don't fail because they're unintelligent. They fail because emotions slowly take control of their decisions. So if you're new to trading, don't focus only on making money quickly. Focus on building discipline first. Trade smaller, stay patient, manage risk carefully. And remember, one trade means nothing in the long run. Consistency is what matters, because in trading, the people who survive emotionally are usually the ones who eventually become consistently profitable.